Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Asymchem Laboratories, Tianjin Co. Limited, quarterly report. Asymchem Laboratories, Tianjin Co. Limited, offers a wide range of services to the pharmaceutical industry. At its core, the company provides contract development and manufacturing organization, CDMO, solutions that cater to various therapeutic areas such as oncology, antiviral, anti-infective, cardiovascular, and diabetes. The company's expertise extends beyond small molecule CDMO services, also offering chemical macromolecule CDMO, biomacromolecule CDMO, including antibody-peptide conjugates, and formulation CDMO. Additionally, Asymchem Laboratories engages in clinical CRO, contract research organization, activities, which involve conducting clinical trials for pharmaceutical companies. The company's business scope also includes synthetic biology and new technology output, as well as key pharmaceutical intermediates, APIs, active pharmaceutical ingredients, and formulations. With its extensive range of services, Asymchem Laboratories has established itself as a leading player in the CDMO industry, providing comprehensive solutions to clients worldwide. Asymchem Laboratories, Tianjin Co. Limited, maintains a market capitalization of $41 billion, broadly in line with the industry peer group. Asymchem Laboratories, Tianjin Co. Limited, trades at a higher price-to-earnings ratio of 31 times and a lower price-to-book ratio of 2 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 13% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. Revenue growth and decline drivers. The primary drivers of revenue growth can be attributed to several key factors. Firstly, operating revenue has seen a significant increase of 16.91%, indicating a strong performance in core business operations. Additionally, revenue from emerging businesses has surged by 74.07%. Showcasing the company's ability to adapt and capitalize on new opportunities. Furthermore, sales of goods and services have risen by 16.5%, demonstrating a consistent growth trend. Lastly, investment income has experienced a substantial increase of 142.1%, contributing to the overall revenue growth. In contrast, there are limited instances of revenue decline. One notable exception is the minor decrease in revenue from small molecule CDMO business, which dropped by 0.43%. However, this decline is relatively insignificant compared to the overall revenue growth drivers mentioned earlier. Overall, these findings suggest that the company's diversified approach and strategic investments have been instrumental in driving revenue growth. The net income of the company underwent a significant change in the given period. Initially, it decreased by 6.82%, but this decrease was later contradicted by an increase of RMB 32,396,208.43. However, further analysis revealed that the net income actually decreased from RMB 324,571,255.22 to RMB 301,155,741.59, which is a decline of 7%. This inconsistency highlights the complexity of the company's financial performance. In terms of profit margins, there were both positive and negative changes observed. The gross profit margin increased for small molecule business and emerging business, indicating an improvement in profitability. Additionally, the adjusted net profit margin saw a significant increase of 27.91%, which suggests that the company was able to manage its costs effectively and maintain a higher level of profitability. However, this positive trend was offset by a decrease in operational profit due to a loss of RMB 12,468,210.51. Nevertheless, the adjusted net profit margin continued to rise, increasing by 2.01 percentage points from 21.44% to 23.45%. This indicates that despite some fluctuations, the company's overall profitability remained stable and even improved over time. The financial health of a company can be gauged by its ability to generate positive operating cash flow. In this case, the company has successfully achieved this milestone. The net cash flow from operating activities is a significant indicator of a company's financial performance. According to the provided information, the company generated RMB 526,663,532.5 in net cash flow from operating activities. This substantial amount indicates that the company is able to cover its operational expenses and generate excess funds. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has experienced some fluctuations over the period under review. Total liabilities and owner's equity have increased by a modest 2.6%. However, this growth is largely driven by an increase in current liabilities, particularly trade payables and other payables and accruals. On the other hand, financial liabilities at fair value through profit or loss have decreased significantly by 36.6%. In terms of interest expenses, there has been a notable increase of 3.1%. This suggests that the company is paying more in interest payments over the period. The decrease in net cash flow from financing activities also indicates that the company may be struggling to manage its debt obligations effectively. The changes in non-current liabilities are less pronounced, with some increases and decreases across different categories. Lease liabilities have decreased by 6.8%, while deferred tax liabilities have increased by 21.7%. Overall, these fluctuations suggest a complex picture of the company's debt management practices. That concludes the financial summary for Asymchem Laboratories, Tianjin Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.